welcome to the TheoTrade afternoon video. I am Blake Young. Today is April 27th, 2023. And today we're going to be discussing GDP slowdown signals a rate cut. As we go into GDP and discuss what is going on here, this is the advanced GDP. GDP, or gross domestic product, is the broadest measure of economic growth, economic health, really. In fact, 2 negative quarters of GDP is considered a recession, so it is the broadest measure. It includes consumers, it includes businesses, it includes government spending, and it includes net imports and exports. So it is the whole picture of the economy. Well, GDP last quarter was 2.9%. This quarter, first quarter of the year, is 1.1%. So the growth rate is slowing down. Now, that is still growth. 1.1% is still growth. We haven't gone negative yet. But this 1.1% was about half of what was forecasted. Additionally, not only was it half of what was forecasted, we adjusted the previous quarter down from 2.9 to 2.6. So advanced GDP looking forward thought, hey, we're on track to make 2.9. Now we have the data and we're past that Q4 of last year, we see that we only grew at 2.6%. So the trajectory that we're really facing right now is pushing GDP lower and slower, which kind of fits what the Fed has been trying to do. They wanted to slow demand. They wanted to curtail inflation by crushing demand. Well, this drop is pushing us towards that level. If we see a similar decline next quarter, in Q2 that will be reported in July, then could we see this quarter revised lower by 0.3, dropping this down to 0.8? Could we see a miss of 1%, and could we be seeing negative as early as July? Now, I don't think that's likely to happen, but it is a possibility because we were still expecting to raise rates next week. In fact, we were expecting to raise rates possibly not just next week, but even in the future. This slowdown in GDP is also signaling a rate cut by fall. In fact, as early as July. But let's take a look at the data here according to the CME Fed Watch Tool. If I jump over to the CME Fed Watch Tool, you're going to see here is the May's data. We're showing 84% possibility of a rate hike next week. Next week's meeting is pointing to 84% likelihood of a rate hike. We're currently between 4.75 and 5%, so we'll call it 4.875. Well, we're at 4.875. We're expecting a 25 basis point rate hike. We've got it almost locked down at 84% probability. That's a very high probability, and our expectations are kind of set. Now, if we get surprised and they don't raise rates, that would be a shock to the system, and we'd probably see a massive rally in equities as we're not seeing that rate hike, and it'll push tech stocks higher. But as we're looking at the data, the slowdown that we saw in GDP didn't come from consumer spending. Consumer spending, which makes up about 2/3 of the U.S. economy, 60 to 65% of GDP, was great. It was gangbusters. Government spending continued to grow, no surprise there, but the slowdown, the weight, the albatross around the GDP's neck has been a decline in business spending. Corporate or business spending fell, and residential fixed income fell, which means that we're not spending money on home buying or on construction. So the slowdown in home buying and construction is a pretty good indication that we are going to see a squeeze in the asset base of the consumer. So consumer spending may have been high the first quarter, but if we're seeing slowdowns in spending, slowdowns in building, we're going to see slowdowns in price and possibly a decline in price, which means the assets that consumers have that they can borrow against, that they can pay down their debt with, is going to get tighter, and we will likely see a tightening of lending. Additionally, if we're spending less in business investments, we're also going to be hiring less and even layoffs. And again, that will squeeze the consumer spending in this next quarter. The meltdown that we saw in banking also has put the pressure on that lending as well. And, we haven't seen that kind of situation in either banking or in the housing since 2008. So what are we really starting to see? Well, 84% likelihood of a rate hike. And if we look out just to next quarter's report, which will be in July, next quarter's GDP, and I'm not sure if we'll report before the Fed meeting or after the Fed meeting as far as the advanced GDP. But what we're seeing is that we're now, just by July, we're pricing in a rate cut. If May, meaning next week, we get a rate hike of 25 basis points, we are now pointing to a 21% chance that we will have a rate cut by July. If we look out to September, now we have a 43%. The highest probability of all the rate levels is that we could have a 25 basis point rate cut by September. 12% that we could have 2 rate cuts by September, and even a 1% that we could have 3 rate cuts by September. So we're now pricing in more probabilities of rate cuts than rate hikes. See, this would be where we're going to be at after next week. And we're pricing in 1, 2, 3 different potentials of rate cuts, 1 of rate hikes, and 1 leaving it alone. So we have arguably a 60% probability that we're going to see rate cuts by September. Now, that rate cut could lead us into heading back towards zero interest rate policy, ZIRP. But the question is, can we see these rate cuts happen without getting inflation in check? Is the negative GDP potential an indication that demand has been squashed and that we're headed towards the recession, but we're heading to the recession after inflation is going to be crushed? That's the question, because inflation is still high, 5 times multiple of what GDP is. If GDP is at 1.1% and we're at 5.5 to 6% inflation, we're running, inflation is costing us 5 times what the economy is growing. Now, as we look at the charts, we go over and look at the ES to start with. The ES, you can see, rallied, is pushing up into this overbought zone right off of fair price. Today is a big day. We're up nearly 1.5% off of that GDP. GDP is showing that we're slowing down, and they're saying, hooray, we have it under control. Demand is under control, so therefore rate cuts. Let's drive this market all the way back up. If we look at the rates, though, starting with the TNX, and home mortgages are based off the 7-year and 10-year notes. But if we look at the TNX, you can see the TNX is climbing. We found a base down here at 3.4%. We're back up at 3.5%. This is a bounce off support, and the rates are rising. So if rates are rising and if bond prices are falling, then we are seeing higher costs to borrow. Well, higher costs to borrow while we're seeing a slowdown in spending in builders shouldn't see builders going higher, but yet we are. So this is all being driven off of almost exclusively the hope, expectation of cheap money. As we look at the home builders, here's the home builders climbing, pushing all the way back and approaching these previous highs. Now, I don't think that we're going to see a massive breakout. I think we actually put some pressure to the top side here and keep it from moving much higher. Because again, if rates are going up on the 10-year, and we're going to raise rates next week, we will probably see further slowdowns and less lending in the home building area, as well as the overall, but in the home building area. So I do think we'll probably put a top in here, but this seems counterintuitive based off rates going up, rates being raised next week, and we are still pricing in now September. We're already pricing in September for the home builders. The market is aggressively looking for reasons to believe the markets are going to go higher and that money is going to be cheap again. As we look at that move, let's go take a look at the US dollar. We'll go over to the dollar index. Here's the dollar DXY. Dollar index, remember, is a basket of currencies versus the US dollar. I've highlighted this in the main room a number of times, and that is all these little bodies here with the long ranges are an indication that we are not seeing any real driving factors during the regular trading hours in the US. All the selling, all the weakness, all the drops that we've seen here in these little tiny bodies tell us that it's the overnight pricing, the overnight selling of the dollar from other markets that has weakened the dollar all the way back down to the support level. Now we're holding here. We've been holding here at the 0% level for a month now. But if we're going to cut rates again by September, we might expect another low. We might expect to see a sell-off. We might expect to see us clear these lows, and we may be headed back to a new low, possibly to 100.9950. And if the dollar weakens, if we see our historic correlations, which is about 2 to 2.5 times correlation, if the US dollar breaks support and just falls back to 100, that little dip from here to here is about 1.15%, which would tell me that we're probably going to see about a 2.5 to 3% continued move up in equities off of this bet that the US dollar is going to weaken and that rates are going to be cut in the future. If we go this full distance move, now we're talking about 2.3%. We might be looking at about 6% rally in equities if these rates cuts in the fall are being priced in. So we could be seeing a drop in the dollar. The dollar could weaken again if those rate cuts happen, and equities are going to try to move higher. The question is, again, going back to the idea of the recession, is the recession that is potentially going to happen with or without inflation? Is it going to be stagflation? Is it going to be recession and inflation is going to get in check so that we can tolerate lower rates or even a ZIRP, zero interest rate policy again? In the meantime, I am watching those yields very carefully, because if the yields continue to rise and the rates are hiked this next week and the 10-year continues to climb, home builders will top out. As a side note, we're getting earnings from MasterCard and Visa. If we look at MasterCard traded in a very, very wide range. They beat earnings expectations, so we push back up into these highs. This also seems like it's going to be a cap. If we look at this from the concept of the idea that this is borrowers, or if we look at it as just transactions, if the consumers are going to be able to borrow less, if consumers are going to see jobs decline or layoffs happen, then this will likely cap out and roll back down possibly to 355. Visa, as you can see here, with those rate hikes going, with the beat in expectations, with the, as far as the earnings go, Visa's continuing to slide. Visa's continuing to fade despite beating expectations. And so I still see this as consumers slowing their transactions, slowing their spending, and as we're watching that slowdown despite the quarter beating expectations, we are pricing in the future. And it looks like we are pricing in a recession. I still think the idea of trading Capital One Financial and Ally to the downside are going to be opportunistic as well. The question is whether we're going to get it a bounce like we saw in the others, beat first quarter and fade as they plan for the future and prepare to lend less and hedge or reduce their exposure in their lending. Check Ally really quick. Sitting here at the 0% level, and they're already past earnings. Again, they rallied after earnings. Now this is a miss, but they rallied after earnings and then faded back down. If we're expecting to see a slowdown in growth, then we'll probably see a slowdown in lending. And these are all on the table as potential short opportunities. Well, that's going to do it for me today. Thanks for watching, everybody. Join me again next week, and have a fantastic day.